Welcome to Shareholder Primacy and Free Float Media, a podcast about activist investing, securities law, and all the ways the financial and legal worlds intersect and collide in real life. I am usually here with Ann Lipton, who's a law professor at Tulane, but Ann is once again going off to some academic conference in some fun place. So Ann and I invited Nell Minow here for an interesting and fun conversation about what she's done and seen in her decades in and around corporate governance and activist investing. Hey, Nell, thanks for joining us. How are you doing this fine day?
I'm doing just fine. I'm very glad to be talking to you.
We are very glad that you're talking to me, too. A little bit of background, for which hard to believe that some people listening here don't know this already, but I'll say it anyway. Lately, Nell has led or helped lead ValueEdge Advisors, which is a consultant for institutional investors on corp gov issues at their portfolio companies. Did I say that right?
Yeah, that's perfect.
Cool, great. But that little blurb doesn't quite do justice to her experience and expertise as the, as we'll say, grand dame of U.S. corporate governance. Hopefully that's okay that I said it that way. All right, cool. Her checkered, illustrious past includes, of course, founding Institutional Shareholder Services, or ISS. We'll talk about that. Also, possibly lesser known to listeners here, she helped lead an actual activist fund. It was called Lens. And then she also helped found and lead a big data firm, GMI, on corporate governance. And so we'll touch on all these as a way to kind of look and set up a fun discussion of some current questions and controversies in corporate governance and activist investing. Let's start at the beginning. And the beginning was in Chicago, right?
Yeah.
Though you haven't lived here for a long time. You know I'm in Chicago.
Yes.
So, and you started as a lawyer, essentially, right?
Yeah. I grew up in Chicago. I went to New Trier High School. I'm sure you know where that is.
Just down the road from me.
Yeah, and that's
We
where
were rivals.
That's where I met my husband, and went to the University of Chicago Law School. And after law school, moved to Washington, thinking that it would just be for a few years and we would go back. But we liked it here.
And stayed there and you were a lawyer for the first few years.
Yes.
At a bunch of different agencies, right?
Yeah, I went to the Environmental Protection Agency. I never imagined that expertise would become so relevant in my current job, but it did. And then I was at the Office of Management and Budget, which is part of the White House, and then I was at the Justice Department.
The EPA was pretty new.
Yeah, it was about 10 years old, and it was the Jimmy Carter administration, and he liked to describe himself as the most passionate environmentalist since Theodore Roosevelt. So it was a real go-go time at the Environmental Protection Agency. It was a wonderful time to be there. And then for the Reagan years, I went to the OMB, which was also the most exciting place in government at that time. So I was very lucky in both circumstances. So it was at OMB that I met Bob Monks, and he was working for then Vice President George Bush, and I was working on the same program at a very different level from him. But I met him, and we very quickly hit it off. We became very good friends very quickly. And so while I was out on maternity leave from the Justice Department, he offered me a job, and he said, I'm starting this new company called Institutional Shareholder Services, and we're going to provide advice on corporate governance to institutional shareholders. So of that sentence, I was familiar with the words advice and we. That's about it. I didn't know any of those other words.
Institutional investors didn't make any sense to you
Knew nothing about that and knew nothing about corporate governance.
So Bob was not an attorney.
Yes, he is.
I don't think. Oh, he is an attorney?
Yeah.
Oh, never mind.
Yeah.
Okay.
Yeah, he went to Harvard Law School.
That kind of kinship.
Yeah, so we got along very well. So anyway, I said to him, well, he kind of explained to me a little bit about what that was. And I thought to myself, well, this is great because it's a wonderful idea, but the entrenched interests of the corporations are going to prevent this from going anywhere, but we'll be on the right side and we'll have a lot of fun. And I said to him, well, I'm about to have this baby. I really can only work 3 days a week. And he said, okay. So that was it. So
where did he get the idea, or do you two get the idea first?
he got the idea. Well, it turned out to be two different ideas, which I'll tell you. So he got the idea because he was running for office unsuccessfully in Maine. And he was driving around, doing various political things, and he went by a river in Maine that was tremendously polluted. It had those little bubbles of toxic substances on it. And he looked at it and he said, who wants this? The government doesn't want it. The community doesn't want it. Who wants this? And he realized that it was really all about externalizing costs, and that he himself was kind of responsible. He had run an investment firm and voted proxies in favor of the people who were doing this. And so he basically went off into the woods and read a lot of books for a couple of years and decided that this was the rise of the institutional investor was going to change everything. And so when George Bush said to him, you can have any job you want in the government, he said, I want to run the ERISA program. And they said, you got to be kidding.
And ERISA was brand new at that point.
Well, yes, it was.
Or relatively new.
Yes, it was. It was about 6 years old. So they said, that has to be the most boring thing on earth. And he said, no. And so he went and he ran the ERISA program. And
that was in Department of Labor?
Yes, that's in the Labor Department. And then he started ISS, and that was where he and I sort of got together. And so when you list all of the different companies I've been with, you have to understand that all of them have been with Bob. So for me, It's all the same company. It's just that it's like a rocket ship that drops off different sections,
like little parts.
Yeah, so we keep selling off parts and keeping other parts. So
keeping the more interesting,
interesting parts,
or something.
Bob and I are both happier with startups than with already running.
All right. So ISS, he kind of got the idea and then recruited you into it.
Yeah, but what happened was he had a completely different idea. When he explained this to me in December, as I was about to have a baby in January, he said, basically, it was all about activism. And
which is what I do.
Then I didn't actually arrive until September. So I walked in the door in September, and he said, okay, I've spent 9 months knocking on the door of everybody that I've met when I was working on ERISA, and all of them said, not only do I have no interest in what you are proposing to me about activism, but I'm going to pretend you were never even here. I'm so opposed to the idea.
Let us not speak of this.
Yeah, that didn't happen.
Again.
So, but he said, 3 of the people that I talked to said, you know what I would like, though? I would really like recommendations on proxy votes. Because up until now, it's been vote for the auditor, vote for the board, go home. There was really nothing exciting. But all of a sudden, because of green mail and poison pills, there were complicated subjects on proxies. And the IRRC, which was started by the Ford Foundation and Harvard to deal with South Africa and Northern Ireland, did not make recommendations. So a couple of people said, we would really like recommendations. So I showed up and he said, okay, everything I told you is out the window. We're not going to do any of that.
We talked about.
Yeah, we're not going to do the activism part because the world isn't ready for us yet. But we're going to do these recommendations. And I said, that is genius, because we could do one recommendation and sell it many, many times.
Oh, you socialize it completely.
Yeah. And I said, and unlike, say, securities analysis, where there's a premium on exclusivity, the more people that get our advice, the better for everybody, because you're going to want everybody to have this advice and vote. I said, it's a much better business. You always want pillow money. You want money that's still coming in when your head's on the pillow. And so we can do these recommendations and sell them over and over and over.
And sell them to many, many people. Basically, it's a high-end subscription service.
Exactly. So I was right, but I wasn't right for a while because it took 2 years. We had one client at that time who was a college friend of Bob's and took pity on us. But 2 years later, in 1988, February 23rd, 1988, which I just remember because it's my birthday, the Labor Department, Bob's old office, issued a ruling saying proxy voting was an asset of
Was
the ERISA
mandatory.
plan.
Well, not mandatory, but you had to take. You had a fiduciary duty
You had
to
a
vote this
fiduciary
stuff.
duty, yeah. And so all of a sudden, then we started getting clients, and
Right.
and then we're off to the races.
So you were just ahead of where you needed to be, and then got there.
Yeah, and so that was ISS, and once that was really up and running, that's when we left to do an activist fund, the Lens Fund.
So that was probably early '90s, I think, based on
It was
this.
1990.
Right. So you weren't at ISS as long as I thought you might have been.
No, I was ISS for 4 years.
Oh wow.
Yeah.
And then you moved on to Found Lens, which
Yes.
Lens that's what's lesser known
Yeah.
to most people, at least listening here, is that you were an actual portfolio manager,
Yeah.
like with limited partners and money and all
Yes.
this kind of stuff.
Yes.
So let's hear about that.
Well, that was really fun. We bought stock in companies that, as my parents used to say about me, were not living up to their potential. And
Okay.
yeah, and then we went to talk to them, and I would say about a third of the time they said, "We're right with you. We know exactly what you're saying, and we're working on it." And about a third of the time they pushed back a little bit, and we had to push them. And then about a third of the time we were in a knockdown, drag-out fight, and the
You're
biggest
really
fights.
going to battle over
The
stuff.
biggest fights we had were with Waste Management, where we ended up replacing the CEO not once but twice, and Sears, where we
Sears,
ended
I
up.
remember Sears was a big deal with Bob.
Yeah, Sears was a big deal with Bob. That was really a wild, wild story, and we ended up taking out a full-page ad in the Wall Street Journal calling the board of directors non-performing assets.
Right.
And so we outperformed the market from 1990 to 2000, which was a very good time for the market. So we did very well.
Yeah.
And we ended up selling Lens to what was at the time the UK's biggest institutional investor, Hermes.
Oh, which is now Federated Hermes.
Right, exactly. And then we spun out and kept our favorite part, which was the research
Which
part.
is the data, GMI.
And that was a dream that I always had ever since my days at ISS. I wanted to rate boards of directors like bonds, AAA to junk. And
Right.
so we sold that product. And I'm sorry to say that we never got any institutional investors interested in it, but we did sell it very well to D&O liability insurers, which I thought was a great sort of market
no kidding.
test, because we were a really good predictor of litigation risk and liability risk. We also were a great predictor of investment risk, and we would have been terrific as short sellers if we had done that. But
Right, if you'd had that appetite to kind of
Yeah.
do that kind of trading, which is
Yeah.
really hard.
that's really hard. So, but anyway, so I can't think of a better market test than the D&O people. That was great. And then we sold that to MSCI
Right.
and kept a little tiny piece, and that's ValueEdge Advisors.
That ValueEdge. Okay. So the trajectory ISS to Lens was logical, but it wasn't like Lens was part of ISS. You had to leave ISS.
Yes.
And then start Lens, and you probably
You can't be the umpire and the pitcher in the
right.
same game.
And you probably had to go get some other kind of skill sets for, I mean, portfolio management
Yes.
and capital allocation.
We did.
I mean, there was,
We did. We had a couple of investment bankers and financial professionals.
right, you had to hire a prime broker. I mean, you had to do all
We had a
that.
relationship. Yeah, right.
A
We did all of
relationship.
that. Yeah.
Right, and then from then, once Hermes grabbed that, go to GMI, or you called it something else, call it the corporate library or something like that.
Yeah, the reason we picked the name the corporate library is that we had such a reputation as bomb throwers and activists. We wanted to pick a very institutional name for the company that would sound very credible. So we called it
non-controversial.
we called it the corporate library. And then when we merged with GMI, we took their name.
Oh, you grabbed their name and got
Yeah.
okay. Okay, so you rebranded a little bit.
Yeah.
So ValueEdge Advisors grew out of GMI.
Yes.
I didn't realize that.
Yes.
All right. So what's it? It's just kind
So
of advice. I don't know. Is like it's full time? Are you doing a lot of it? Is it kind of when you feel like?
I'm still working 3 days a week.
Oh wow. Okay.
Nothing has changed. I never worked full time in any of those jobs.
Well, you were able to do other stuff like watch movies and.
Yeah, I have a second full-time job as a movie critic. But that was a sunk cost. I was already going to go to a lot of movies. I had to figure out a way to monetize it. So, but yeah, I think Bob, once a year, Bob would take me to lunch and say, let's talk about you. What are you looking for? And I think he felt, when my children went to school or maybe when they went to college, that I would work full-time. But
go back to 5 days a week.
I never
do
did.
Something right.
I never did.
Right. The last time you did that was at the Department of Justice, probably.
No, because I was already working 3 days a week there because I had a child.
The government
yeah.
too. Okay.
So but in the government, but before that, before my son was born, I did work full time.
Wow. All right. So ValueEdge is consulting firm, basically, right?
Yeah.
All right.
We put on a conference every year for public funds. And I write reports for our clients about what's going on in the wacky world of corporate governance every month. But also, it's a very deep in the weeds Washington kind of job for me, which I like, which is that I file comments on rulemakings and sort of follow what's going on in Washington.
All right. So it's you have and your clients sound really like investors.
Yeah.
So you're not doing any work for boards or
never, not
at all.
Never, no. I would never do any. I don't think you can do both. And when I was at ISS, we did not do any consulting work for boards.
Oh, before so the whole ISS corporate kind of took off much later.
I refused to do that. I was president of ISS for 1 year after Bob left, and then I joined him a year later. I didn't do it, but in fairness to ISS, there were consulting firms that were selling products like how to get a good rating from ISS. We were leaving a lot of money on the table, and there were companies that were mad at us because they said, you give us a grade, but you don't tell us how to get better. So I understand that, but I don't think it's a good idea, and I still wouldn't do it if I were there.
Yeah, no, I did some looking into this at one point, and Ann and I did a podcast on this, where there are some legitimate questions about what they should or shouldn't do. But to the extent that they are doing it, it seems like they've put up some of the right barriers to trying to mitigate the conflict. Yeah,
absolutely. But I'm not there, and if I were there, I still wouldn't do it. Yeah, I know. I understand. Well, but yeah. So no, I have a couple of times been offered the opportunity to advise boards of directors, and I won't do that because you can't do both.
Boards have so much available to them between dozens of law firms and solicitors and investment banks.
Yeah, but they give them terrible advice.
Oh wait, I'm not saying the advice is good. I'm just saying that if you're on a board, the last thing you need is you or me.
Yeah,
but there's so little available to investors.
Yeah. I would find it very hard to, well, let me put it this way. Bob Monks and I often quote Upton Sinclair, who said it's impossible to make a man understand something if his paycheck depends on his not understanding it.
That's right. So, wow. With that, there's a whole bunch of stuff I really want to ask you about, like about what's going on today and what might be happening, and using your trajectory as a way to inform some of that discussion. If we could do that,
sure,
I would love to. But let's do that after a quick break.
Shareholder Primacy is brought to you by FreeFlowAnalytics.com, the only free database of corporate directors, their influence, and their performance. If you own a stock or retirement plan, go to FreeFlowAnalytics.com and look up which of your elected directors are performing well and which aren't. Use your vote in the alternative democracy and get your data at FreeFlowAnalytics.com. Now, back to the show.
Welcome back to Shareholder Primacy. I'm Mike Levin, talking here with Nell Minow about all things Corp Gov and activist investing. We just kind of finished talking about, what you've learned at ValueEdge and ISS and so forth. But let's start to think about how these experiences provide kind of a comprehensive basis for some views about what's going on at activism and corporate governance today. And there's a whole different list of things we can talk about. We started talking a minute ago about proxy advisors, ISS, of course, Glass Lewis. Clearly, you have your view about what kind of businesses they should be in, but what are they in for? What are you thinking about when you think about that firm you created?
Just like any other company, it's very market driven. And it's so absurd to me that people talk about how influential it is when the data is exactly the opposite. The data shows that to the extent that there's any item on a proxy that is in any way controversial or complicated, the clients like the analysis and then make up their own decisions. And over 90% of the recommendations ISS gives are to vote with management, because over 90% of the items on a proxy are vote for the board of directors, vote for the auditor. Right. So, it's hard for me to imagine why corporations are so upset about it, but I've learned over the years that the very people who rhapsodize about the purity of the free market are the first to squeal when the free market doesn't like whatever it is they're putting out there.
Well put.
So, it's a very kill the messenger thing. Unlike, say, the ratings agencies or the securities analysts, they're exclusively paid for by the users of their product. And so corporations cannot influence them. And that's what makes it valuable.
I have always been mostly a fan, but you're right that they're basically an intermediary, a way that institutional investors kind of express their views. I mean, ISS and Glass Lewis are assiduous in how they kind of solicit their input,
which is
from
what
their clients,
people who are in business, people in business do that. Right. If you sell pizza flavored toothpaste and nobody buys it, that's when you say maybe I should do something different.
Pizza flavored toothpaste.
Yeah. So. Yeah, and if you want to get proxy advice, you can go with the firm that does do consulting. You can go with a firm that doesn't do consulting. Sure. Or you can do it all in-house. It's a product that nobody has to buy. A lot of institutional investors don't buy it. So it's hard for me to imagine why the corporate community is so frantic about it, but there it is.
Right, yeah, and they really want to regulate it really hard.
Yeah.
And I think the SEC has so much better to do.
Yeah.
These days than try to focus. I mean, I don't think there's ever been a complaint to SEC enforcement about any of these conflicts or any of what they do. I don't think.
No, there hasn't. And the corporate community says, they've got an under 1% error rate. Well, any of the corporations that has under a 1% error rate, must be doing very well. And they correct their mistakes just like anybody else. And their advice is very moderate. If I were still there, they would be much more aggressive.
Yeah. Let me ask you about something else. Let's talk a little bit about ESG and activism and so forth. And as an investment style, it's maybe falling out of favor a little bit. And to my ear, you focus a lot of your thinking on the G part of ESG. I'd love to hear if I'm wrong or how that's not quite right.
Well,
and then I want to ask kind of where that whole trend is going.
I think we understand the G part a lot better than we understand the S, which is a catch-all, and the E, which is very complicated. But I would say that they're all important. ESG as a term has fallen out of favor. I don't think as a concept it has. It's hard to say that generally accepted accounting principles have been definitively accurate over the years. We've been
Right.
struggling with them for over a century, and they still get revised every year, and they still sometimes fool us when we have situations like the financial meltdown. So,
Right.
so I think what I would call them is possibly non-traditional indicators or adjunct indicators. I saw that the big banks have all said that they think that we're not going to meet the Paris targets, and so they're going to revising some of their ideas about the future of various investments. If you're going to have a portfolio company that's got shoreline property in North and South Carolina, you're going to have to think about what that means going forward. So it's really just a question of enhanced risk assessment. Now, governance, I think we understand better because there are fewer factors to look at. And I just want to say there that the reason that our rating of boards of directors was so accurate is that
At GMI.
at GMI.
That rating. Okay.
That rating, yeah. The reason it was so accurate, this is something I'm especially proud of, is that we didn't rate them on what they said they did. ISS will give them a good rating if their governance policies are on their website. I don't care about that. I care about what their decisions are. So we looked at basically three things. We said there are three very tough decisions that boards have to make where the CEO may have interests that are contrary to the interests of the investors. First one, obviously, CEO pay. The investors want a lot of variability in CEO pay. The CEO wants less variability.
Wants it really high and steady.
Yeah. And so if the board can't mediate that conflict in favor of the shareholders, then it's not a good board. And I don't care what their resumes say about their independence. We once had at Lens, one of our portfolio companies, the board consisted of the CEO, the CFO, the company's lawyer, the company's investment banker, and another guy. And the other guy looked like an independent director for the SEC and the New York Stock Exchange criteria, but he was on the CEO's jazz band and they played together on weekends. So you're not going to learn anything about independence by looking at what the disclosures are. You have to look at their decisions.
To really dig into their decision making.
Yeah,
and
so
get into,
CEO pay is obviously key. If they're giving Elon Musk, not that we had any delusions about the board at Tesla, with Elon Musk's brother, the chef, on the board. But if they're going to agree to a $56 billion pay package for him, it's a bad board. It's a terrible board. Okay, so that's one. Item number two is transparency. The CEO would prefer a little bit of obfuscation in terms of their financial reports. And shareholders obviously want to have as much clarity as possible. So if the audit committee cannot be on top of that and working on behalf of the shareholders, it's a bad board. And then the third one, I think you'll appreciate, is acquisitions, because companies like to make a lot of acquisitions, and most of the time they don't end up adding value.
Or they waste a lot of money.
And they waste a ton of money.
It's vanity projects or it's weird stuff.
Yeah. So those are some of the key criteria that we looked at, but it was only in terms of their decisions that they made, not in terms of what they said they were doing.
So what's going to happen here? I mean, there's been some data even this year that the whole, a lot of the ESG proposals are way down.
Yeah.
The SEC is like leaning on these proposals much harder.
Yeah.
What can we expect? Or what are you seeing?
Well, certainly the pendulum has swung very hard in the other direction from where it was a year ago. And by the way, you can't just go by counting proposals, because quite often, in fact, I was on a call about this yesterday, quite often the proposals get withdrawn because they've got a negotiation. Sure. So you sometimes that's the dogs that don't bark. Sometimes that's good news. But I do think that the people with the green eye shades and the sharpened pencils are understanding environmental risk better, climate risk better. And so I think you will continue to see this. Let me put it this way. I was last month at the Council of Institutional Investors annual spring meeting in Washington, and the commitment to looking at climate risk and DEI was unqualified. There was not one person there who said, I think it's time for us to back off.
None of what we've been seeing lately scared any of that community.
Not at all, no.
Because I have a little vision, at least short term, I'm kind of curious what you think of it, is that a lot of the governance stuff, which we just talked about, and governance proposals and governance changes will not necessarily sail through, but will proceed as it has, which is getting some pushback from companies and so forth, but they're not going to face nearly the opposition that corporations have been mounting against, environment and climate and a lot of the broad social type of initiatives.
Yeah, I've seen some of that, companies that are unclassifying their boards and making other changes.
Yeah.
But I'll tell you what I think. I think that the big corporations hate what's going on in the government right now. And I think you're going to see them making,
especially this week. Oh my God.
especially this week. But they hate, you know what corporations don't like is uncertainty. And this is all just much too chaotic and much too crazy. And I think you're going to see them, they hire a lot of lobbyists. They will be complaining to their representatives in Congress. And I think you're going to see a lot more pushback coming from the corporate community.
They're going to welcome what life used to be like when
Yes.
you just had to deal with a bunch of ESG proposals. And
Yeah,
try to
exactly.
negotiate with a bunch of pension
And I know you
funds
know
and-
this, but let me just
and advocates.
re-emphasize that even 100% vote on a shareholder proposal is advisory only. The company doesn't
yeah.
have to do anything about it.
Of course. So, all right. So that's the ESG trend, and
I also
ahead.
want to mention, I know you know this, that we're getting a huge number of extremist right-wing anti-ESG proposals, anti-DEI proposals, and they're all getting single
they're
digits.
getting 1-2%, getting no support.
No support whatsoever. So that shows you that shareholders are paying attention and that even a subject line about diversity is not fooling them.
I have a little hypothesis that I need to develop a little more. Mm-hmm. But I think that the abject failure of a lot of these anti-ESG proposals, and there's been dozens more this year than there were even a couple of years ago.
Yeah.
And there's a couple of proponents that are kind of Washington lobbyist type cousins that are promoting this, the National Center of Public Policy,
Yeah.
whatever, I can't remember. I think that their low level of support reflects as much the fact that big indexers don't like many shareholder proposals
Yeah.
of any type, much less, and they probably have a special, bit of contempt for these, but that overall the big indexers just, the governance ones they'll kind of look at, but they've kind of run into, with BlackRock and so forth, they run into kind of this bit of fatigue, I suppose. I don't know if what do you think of that?
You know what? There's a big gap between the good proposals and the bad proposals.
Oh,
The
yeah.
good proposals get 30, 40, sometimes even 60%
Oh, that's a good
of the
point.
vote. So I think they can distinguish.
All right, cool. We're going to start to run out a little bit of time here, so let me just throw out sort of a broad question and say what are things you've been thinking about in terms of governance and corporate governance and activism lately? What's been occupying your thinking so far?
First, I want to say that you mentioned the National Center for Legal Policy or whatever their name
Public
is.
policy research.
I want to, well, there are two different ones, and they have very similar names that that submit these anti-DEI proposals because it relates to my answer to your question. Did you know that they're both funded by the same people that funded Project 2025?
I did not.
Yeah, they're just sock puppets for Project 2025, and that's
Or the same people who give the money to Heritage and all that.
yeah. And
wow.
yeah. So it's the exact same people. That's exactly who they are. They don't manage money. They just have accumulated
Right.
enough stock. Yeah.
Right.
So-
or they're not doing what. There's a lot of ESG proponents that, we've been kind of referring to here that may not themselves have a lot of assets. Some of them do, Trillium and so forth. They got plenty of money.
No, but some of them are
But
John
they're
Chevedden.
representing, they're working closely with big
Right.
investors.
Yeah. Some
Yeah.
like John Chevedden
But
and
these
Jim
folks
McRitchie.
aren't.
Yeah, Jim McRitchie. No. These people are, as I said, they're sock puppets for the Scaife and the Mellons and the
Got it.
Cokes, and so you should
Sure.
always look and see where the as
Follow the money.
Deep Throat said, follow the money. Okay.
Yep.
So we have a historical marker at exactly where he was when he said that, right near my house. So
Oh, God.
So that's actually my primary concern right now is the proliferation of these fake groups that file comments on federal rulemakings. That's why I've been focusing on that, so that
interesting.
I just bust them a lot. And I say, when these people who have these very institutional names and sound like they are rock solid, objective folks, let's look at where their money is coming from and keep that in mind when you look at it. And that's why I've been spending so much time filing comments so that I can respond to some of these bad actors.
Sure. Wow. All right. What have you been hearing? Anything important or notable from like your consulting work and so forth? Other things you want to kind of mention here before we?
The main thing is, as I said, that at the CII, I was very heartened to hear that there's an undiminished commitment to the genuine risk involved in failing to address the environment, the HR
Some of
stuff,
these social issues.
the governance stuff. So I'm very happy about that. And I am watching corporations. I think, particularly with these tariffs, I think you're going to hear more pushback from them.
Oh, I think they're going to establish, potentially some sort of a alliances with, some of the folks we've been talking about here to sort of push back in ways
Yeah.
that people haven't quite foreseen yet.
Well, it was very heartening to see that Elon Musk did such a face plant in Wisconsin. You can't
Oh,
buy.
I was very intrigued by that.
Yeah.
I mean,
So
right up the road from us here.
I think he's now a drag on the stock.
Yeah, and it's really interesting. I think I've been involved
do.
and active in some matters involving Tesla, and I think the prevailing settlement. And I've talked to a bunch of people. I've talked to some former employees that have reached out and so forth. Everybody just wants the guy back. As much as he's hard to work for, they need him at the company. The company's share price is completely reliant on
Yeah.
him.
He's
the
I say-
reason it's not trading like a car company.
He's Betty Crocker. He's Walt Disney. He's
Yeah.
he's the Jolly Green Giant. He's the brand of the company, for better for worse. He made it that way. And
Yeah.
this is going to sound very quaint, but I donated almost all of my Tesla stock last year, just exactly at this time. I waited long enough to vote no on the pay package, and then I
Yeah.
donated because he was spending too much time at his other companies.
Yeah.
So,
I mean,
so
we need him back.
Now
and
that's-
not because we love the guy, but because the share price depends on it.
yeah.
Wow. All right, now, this is terrific. I hope you've enjoyed talking about some of this stuff and
Very
and
much.
reliving your history.
Yes, indeed.
We're gonna have to wrap this up, though.
Thank you for having me
It's
on.
been terrific talking to you. So this is Shareholder Primacy, hosted normally by Ann Lipton and me, Mike Levin, but today we've been with Nell Minow. I'm an independent activist investor and advisor to investors about their activist situations. Nell helps lead ValueEdge advisors, consulting to institutional investors about corporate governance at portfolio companies. You can find me, Mike, at theactivistinvestor.com and Nell at ValueEdge Advisors, one word, no punctuation.com. Our podcast is produced and distributed by Free Float Media. Thanks for listening, and we'll talk again soon.